NetPower, ticker NPWR, just reported Q2 2026 results. And the top and bottom line numbers are a massive miss across the board. We are looking at a GAAP loss of, well, negative 91 cents per share.
Yeah, which is huge.
Right. That misses the consensus estimate of a 5-cent loss by a staggering 86 cents. And on the top line, revenue came in at absolute zero.
Literally zero.
Literally zero. And while that actually met the $0 expectation of a few analysts who, track them purely as a pre-commercial entity, it completely wiped out the $9 million forecast from consensus models that were banking on early equipment sales.
And management also stripped away any standard forward guidance you might have been looking for to kind of soften that blow.
Yeah, they really did.
They declined to issue traditional near-term quantitative financial guidance entirely. What they delivered instead was this heavily revised, purely qualitative operational roadmap, pushing their commercial timeline out to 2028.
Which, makes the ensuing stock reaction the single most interesting part of this entire print.
Oh, absolutely.
If you were watching the tape, NPWR initially slipped 1.85% in pre-market trading, dipping to $1.59, which is the textbook reaction to an 1,800% EPS miss.
Exactly what you'd expect.
But once the regular session opened and the market actually started digesting the earnings call, the stock staged a violent positive reversal. It surged 20.37% on incredibly heavy volume, moving 4 million shares to close at $1.95.
And just to, put that volume in perspective for you, 4 million shares is about 5 times their daily average.
Wow.
Yeah. That kind of liquidity isn't retail traders just taking a punt. It is institutional money aggressively stepping in, buying up shares, and really buying into a brand new narrative. Wiping the slate clean on earnings gave those institutions the exact signal they were looking for.
So today, for this deep dive, we are taking the earnings call transcript, the balance sheets, and the Wall Street analyst notes to figure out how a clean energy startup rewarded its investors by taking a massive accounting hit and fundamentally altering their core business model.
It's a wild pivot.
It really is. Okay, let's unpack this. Let's look at the mechanics of this GAAP loss, because to understand a 20% spike on a negative 91-cent print, you really have to dissect the balance sheet.
Yeah, you do, because the headline net loss was $206.9 million. But for anyone modeling the actual cash burn of the company, that number is highly deceptive.
Right, because it wasn't a cash burn.
Exactly. This loss was driven almost entirely by a $193.7 million non-cash impairment charge. Not a single dollar of that $193 million actually left their bank account. NetPower basically took a pen and wrote down the value of their legacy oxy-combustion technology, along with their LaPorte demonstration facility, straight to zero.
Just zeroed it out.
Zeroed it out. They have indefinitely suspended the development of the proprietary technology the entire company was originally founded on.
Wait, for a clean tech developer, writing off your core proprietary technology sounds exactly like, say, a software company deciding to permanently delete its own source code.
It's a bold move, yeah.
If you are an investor who bought into a clean energy startup and they suddenly delete the clean part of their intellectual property, you would expect a mass exodus, not a 20% rally.
What's fascinating here is you have to view this through the lens of institutional risk assessment.
Okay.
For years, that proprietary oxy-combustion cycle wasn't viewed by Wall Street as some golden goose. It was viewed as a massive, speculative overhang.
Just too risky.
Way too risky. Just look at the mechanics of oxy-combustion. You are burning natural gas with pure oxygen to inherently capture CO2 and produce power.
Right.
And, the physics work, but doing it at a commercial gigawatt scale requires massive air separation units. It is wildly complex, the capital expenditures are massive, and commercial banks despise funding science experiments.
Yeah, they want sure things.
Right. So by writing that asset down to zero on the balance sheet, management basically capitulated to physical and financial reality. They removed the technology risk.
So they admitted defeat on the proprietary tech, which instantly makes them a much safer bet to just act as a conventional power plant developer.
Precisely.
Wiping that $193 million tech overhang off the books isn't just an accounting trick. It is the prerequisite for them to utilize the liquidity they actually have.
And they are sitting on a balance sheet that is remarkably robust for a development stage infrastructure play. They closed out the quarter with roughly $310 million in cash equivalents, in short-term investments.
Against an incredibly light debt load, too. I mean, the total debt is sitting at a mere $3.55 million.
It's nothing.
Yeah, if a vendor knocks on their door tomorrow demanding everything they are owed in the short term, Net Power can write that check almost 24 times over without breaking a sweat. That current ratio of 23.82 is just massive.
And management explicitly leaned on that ratio during the call. They stated it gives them the runway to operate for at least the next 12 months without needing to dilute shareholders with an equity raise. As long as they don't lock into new, unfunded equipment commitments, they have the capital patience to negotiate terms from a position of relative strength rather than desperation.
Which brings us to the actual strategy driving the stock price. Because having the runway to survive is one thing, but the institutional buying was driven by CEO Danny Rice's strategic pivot.
The big pivot, yeah.
This is a direct, unfiltered response to the immediate demands of the AI and hyperscaler market, and it requires a total structural realignment of their flagship asset.
Right. Project Permian out in West Texas is being completely redesigned from the ground up.
Yeah.
Originally, this was modeled and pitched as an 80-megawatt clean power facility utilizing that now abandoned oxy-combustion tech.
Right, the science project.
Exactly. Today, the blueprint has been ripped up. They are pivoting to a 1 to 1.5 gigawatt unabated behind-the-meter natural gas power development.
Unabated, no carbon capture at the start, just burning natural gas the old-fashioned way to generate massive amounts of electricity.
Right.
And the underlying mechanism forcing this pivot is grid congestion. If you look at ERCOT, which manages the power grid for the vast majority of Texas, their interconnection queues are an absolute nightmare.
Look, a mess.
We are talking about grid connection wait times stretching deep into the 2030s for large industrial loads.
You really have to consider the physical reality of grid expansion here. You cannot just plug a gigawatt-scale AI data center into the existing transmission infrastructure.
You'd fry the grid.
Exactly. It requires years of grid impact studies, acquiring land rights for new high-voltage transmission lines, and physically upgrading substations.
It's a decade-long process.
Right. If a hyperscaler like a Microsoft, Google, or Amazon wants to build a massive AI training facility today, they cannot afford a 7-year bureaucratic waiting period.
It's like a tech giant wanting to build a cutting-edge manufacturing plant, but the public toll roads leading to the site are scheduled to be stuck in gridlock for the next decade.
That's a great way to put it.
So instead of waiting for the city to widen the roads, Net Power is stepping in and offering to build a massive private highway directly to the factory doors.
Yes.
By building a behind-the-meter gas plant, they are bypassing the ERCOT public grid entirely. They are co-locating the power generation right next to the data center, off-grid, pushing for an accelerated 2028 timeline.
And that private highway solves the single biggest bottleneck in the AI arms race, which is speed to market.
Speed is everything right now.
It really is. The initial phase of this newly redesigned Project Permian is sized at roughly 200 megawatts. And to get there quickly, they've already contracted 2 modular gas turbines that will provide about 68 megawatts. And they are actively procuring another 120 megawatts of standardized equipment in coordination with a prospective customer.
Because delivering power to a modern AI data center is a completely different beast than feeding power into a municipal grid. It isn't just about throwing total megawatts at a building.
No, not at all.
It is about absolute, uninterrupted uptime. These hyperscalers demand what the industry calls 3 nines reliability. That means 99.9% uptime, equating to barely a handful of hours of downtime across an entire year.
Which is incredibly hard to do.
Yeah, you cannot achieve that by just plugging in one giant gas turbine, because the second you have to turn that turbine off for routine maintenance or an unexpected mechanical trip, the entire data center goes dark.
Right, and this is why the specific engineering details management shared on the call are so vital. To guarantee that 99.9% uptime, they are moving away from monolithic generation and deploying a technology-agnostic, highly redundant microgrid. They are layering different types of power generation. So the current design integrates standard gas turbines, reciprocating engines, and battery energy storage systems, all into a single cohesive power campus.
So it functions exactly like a hospital's backup power system. If the main surgeon, in this case the large gas turbine, needs to step out of the operating room, you don't pause the surgery. The reciprocating engines and the battery storage act as the backup surgical team that is already scrubbed in. The batteries handle the immediate millisecond drop in voltage, and the reciprocating engines spool up instantly to take over the sustained load, so the AI training models never even register a flicker in the lights.
And that seamless handoff is the entire value proposition for the hyperscaler. It creates a resilient, modular microgrid designed specifically for continuous, high-density AI workloads.
Yeah.
But, stepping back from the engineering for a second, this still leaves a massive philosophical shift on the table. If we connect this to the bigger picture, a clean energy startup is now dedicating its capital to building traditional, dirty fossil fuel plants.
Well, management claims the decarbonization thesis isn't dead, just resequenced.
Right, later phases.
Yeah, they deferred the carbon capture elements to what they vaguely call later phases. They pointed out they still maintain a relationship with Entropy, a firm that specializes in post-combustion carbon capture retrofits. And they also maintain their land footprint and their critical relationship with Occidental Petroleum, giving them a pathway for eventual CO2 offtake via enhanced oil recovery.
I mean, designing the site footprint today so that you leave physical space for post-combustion capture tech tomorrow is certainly pragmatic.
Yeah.
But refusing to commit capital to that clean tech today changes the entire investment profile. They are letting raw customer demand and project economics dictate the timeline.
Yeah, they are.
The market is demanding raw, immediate power, so they are prioritizing speed and scale today and leaving the decarbonization problem for some time in the future.
Which perfectly explains the stock surge. The market loves pragmatism over idealism.
Yeah.
But pivoting to unabated gas mid-flight introduces a whole new set of hurdles for project execution. Wall Street research is already fracturing over how to model this risk.
Oh, definitely.
We saw Barclays upgrade NPWR to equal weight, actually raising their price target from $2 to $3.
Yeah, Barclays essentially rewarded them for dropping the science project. Standardized gas turbines and retrofittable post-combustion capture represent known, bankable commodities. You can easily model the capital expenditures and maintenance costs of standard equipment.
But then look at Citigroup's note. They kept a buy rating, but slashed their price target from $6 all the way down to $4.
Right.
To me, that reads like Citi is heavily penalizing them for indefinitely delaying the final investment decision, or FID. By pushing the FID into the unknown, the core technological differentiation, the eventual clean aspect of the power, is pushed so far out, it becomes almost impossible to value in a discounted cash flow model.
And the timeline uncertainty is a massive drag on valuation. Originally, Net Power had a clear target to reach FID for Project Permian in 2026.
Right.
Explicitly postponing that milestone indefinitely means the institutional investors have no clear sightline to when shovels actually hit the dirt, despite the accelerated 2028 operational target. Citi is acknowledging the massive demand for behind-the-meter gas, but their valuation models require concrete deployment schedules.
Here's where it gets really interesting, though, because this brings us to the most glaring commercial gap in this entire earnings report.
The PPAs.
Exactly. It is, frankly, a bit concerning for anyone jumping into the stock purely on the AI momentum. Despite this incredibly aggressive narrative about getting gigawatts of power flowing by 2028, Net Power reported 0 binding customer offtake agreements.
Nothing signed.
There are no signed power purchase agreements, or PPAs, on the books. They have this grand vision for a massive private energy highway in West Texas. But as of this call, no hyperscaler has actually signed on the dotted line to buy the electricity.
And we really need to categorize the execution risks this commercial gap creates, because they compound on each other.
They snowball, yeah.
The first bucket of risk is capital exposure. As we established, Project Permian is indefinitely pre-FID. The board has not officially greenlit the full capital deployment.
Right.
Yet, to secure long-lead items in a heavily constrained global supply chain, the company is already carrying $55.8 million in remaining purchase commitments for equipment through 2028.
So they are legally on the hook to buy tens of millions of dollars in power generation equipment for a project that lacks both official board sanction and a contracted customer.
Yeah.
That is a calculated gamble to ensure they have turbines when they actually need them, but if a customer falls through, that is a very real, very heavy financial obligation sitting on their books.
Absolutely. And the second, and perhaps most critical risk, involves the mechanics of project financing. Funding the construction of a 1 to 1.5 gigawatt power campus is a billion-dollar endeavor. It requires massive amounts of capital structure, project-level debt from commercial banks, partner equity, or new corporate equity.
And banks don't just hand that out.
No, commercial banks do not syndicate billion-dollar loans based on a promising slide deck about the future of artificial intelligence.
Project finance relies entirely on predictable, mathematically guaranteed cash flows. A commercial lender needs to see a 15 to 20-year power purchase agreement from a heavily creditworthy entity like an investment-grade hyperscaler with strict take-or-pay
I
clauses.
got
Without that signed PPA acting as the collateral, the lenders will not release the debt.
And if the debt markets are closed to them because they lack a PPA, Net Power would have to rely on their own balance sheet.
Which isn't big enough.
Right. Even with a healthy $310 million in cash, they do not have the liquidity to self-fund a gigawatt-scale development. That forces them into the equity markets, which would mean issuing millions of new shares and heavily diluting the very investors who just bought into this 20% rally. The entire domino effect of building this plant starts and ends with getting a customer to sign a binding contract.
Which makes the final risk factor we need to look at incredibly relevant to the current retail sentiment. While management is telling a highly optimistic story about massive future growth, AI integration, and 2028 timelines, key insiders are actively taking chips off the table.
Yeah, the SEC filings point to a notable headwind regarding insider confidence. Eight Rivers Capital, which sits as a director and holds a 10% ownership stake in Net Power via an entity called NPEH, LLC, executed a massive block sale right around the time of this earnings release.
The timing is wild.
Between August 12th and August 14th, they liquidated 757,100 shares of Class A stock, pulling roughly $1.4 million out of the company.
I mean, liquidating $1.5 million of stock. The exact same week, the management team is asking the public market to trust a massive, high-wire strategic pivot is a terrible look.
Isn't that great?
It is the classic watch what they do, not what they say dynamic. If pivoting to behind-the-meter unabated gas is truly a slam dunk for rapid value creation, you have to ask why a major 10% insider is reducing their exposure so heavily at these price levels.
It forces any rigorous investor to question the internal alignment on the execution timeline. It acts as a hard data point suggesting that securing those binding PPAs, navigating the project financing, and actually getting steel in the ground might be significantly rockier or more dilutive than the optimistic 2028 target suggests.
So if you are an investor trying to synthesize this entire deep dive into an actionable thesis, Net Power's Q2 was defined by a massive $193.7 million accounting hit that allowed them to essentially delete their own proprietary clean tech source code.
Yep, wiped it out.
They cleared the decks to execute a highly pragmatic speed-to-market pivot. They recognize that the public ERCOT grid is gridlocked until the 2030s, so they are building a private, highly redundant energy highway in West Texas to feed AI's immediate appetite for off-grid gas power.
Exactly.
They possess the cash runway to survive the near-term planning phase, but until they actually get a hyperscaler to sign a binding, bankable contract, this is all just a very expensive, high-risk development plan with insiders actively selling into the narrative.
Which really leaves you with a broader, perhaps more structural question to consider as you watch this space evolve.
Oh.
Yeah, if the immediate massive power demands of the artificial intelligence revolution are forcing well-funded clean energy startups to indefinitely suspend their proprietary clean tech just so they can get unabated fossil fuel plants built faster, what does this actually mean for the global decarbonization timeline?
That's a great point.
Is the rapid expansion of the AI boom fundamentally incompatible with the green transition in the short term?
That structural tension between technological ambition and physical energy reality is exactly what makes digging into these earnings reports so critical. We are going to be tracking the fallout of this pivot and many others across the infrastructure space. Make sure you follow the show for our daily earnings coverage so you never miss a beat on how these massive market shifts are playing out in real time.